You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 23rd of September and I'm joined by my co-host John McEwen. And in this week's episode, we'll be discussing Tritax Big Box REIT, Prudential, JD Sports, M&G, Regional REIT, and our US company is Nvidia. John, should I start us off with Tritax, a favourite of the show?
Yes, absolutely. How are they doing?
Well, there's not really much of an update in terms of results, unfortunately. But we did cover the results recently, and one of the things we talked about was that they had, it looked like, agreed a deal with Warehouse REIT for acquisition, in that deal had been approved or recommended to the shareholders by the Warehouse REIT board. So what's happened is Warehouse REIT has, on the 11th of July, Warehouse REIT decided to withdraw its recommendation that the shareholders accept Tritax Big Box's offer. Tritax, I think, were considering whether to make another offer. However, since then, Blackstone have increased their bid and Warehouse REIT has accepted that their shareholders accept that instead. But yeah, on the 22nd of August, Tritax announced that they had no intention of improving the offer. So that deal's now dead. And it also means that Tritax is barred from making another offer for 12 months without the Warehouse REIT's board's consent. By that point, I imagine it will have been acquired by Blackstone, so that the chance will be gone. So I think it's worth mentioning, because we did cover it in quite a bit of detail last time we covered Tritax. The offer had been 485 million. And for context, that's 485 million out of a market cap for Tritax of 3.5 billion. So would have been about 20% of the market cap. I don't think this is a huge issue. I think it would have been a good acquisition. I think it did seem like quite a good fit. Last year, they did take over UK Commercial Property REIT, which I think also was a good acquisition. But I think they've got a really, really high quality portfolio. I think they've got some really good properties. It's a REIT that I really like. I don't own shares, but I'd be quite happy with them as they are. I think if the board don't feel like they're getting the value for money from Warehouse REIT by increasing the price, I'd probably, based on what I've seen in the years we've covered them, I'd be quite comfortable to trust them on that. And I'm sure they'll go and find something else. Or if not, I think with those kind of properties, I think you'll still get a very good return. I don't think it's dependent on Warehouse REIT to drive it forward. In terms of the valuation, the business trades at a forward price to book of 0.69, and that compares to a 10-year average of 0.91. It's worth mentioning that 10-year forward average of 0.91, that is quite high for a REIT. Normally, you would expect kind of like a 20% discount. But I think, again, that reflects the quality that historically it has traded so close to the book value. In terms of the yield, the prospective yield at the moment is 5.9%, and that, again, compares to a 10-year average of 4.7%. I think my view is I like it. It's on the watch list. I think it's got some really high quality companies. I think it's in an industry that I would expect to do very well. This is probably one of the highest things up on my watch list. I don't know what it would take for me to pull the trigger. It would probably, I think it's that I'd need to get rid of something, but it's a business I'm very, very interested in. What about you, John?
Yeah, no, I like it a lot. I think it's fairly defensive, but on the growth trends, e-commerce and data centers, it does seem very well run. I think I do have supermarket income REITs in my portfolio. The other thing that I'm quite interested in is primary health properties. I think with the acquisition of Assura and I suppose the certainty of the income is probably arguably even more defensive. And that's currently got a dividend yield of nearly 8%. So that's possibly slightly higher on my watch list. But I do like Tritax a lot. And I know we've covered it a few times and I've said that, but it's fairly high up there on the watch list too.
Would it make any difference for you that this Warehouse REIT deal isn't going through?
Not especially, no.
Fair enough. Right, shall we move on to Prudential?
Yes, so we've covered it plenty of times on the show. It's a company that I used to own. It's a big insurer, but now it's got an Asian, it's primarily Asian now in terms of the markets that it operates in. It had its half-year results out with the group reporting first half annual premium equivalent APE sales of $3.3 billion, up 5%, ignoring currency moves, and underlying operating profit up 6% to $1.6 billion. New business profit rose 12% to $1.3 billion, driven by higher volumes and improving margins. The asset management business, Eastspring, rose 7% since the start of the year to $274.9 billion. The free surplus ratio, its preferred measure of balance sheet strength, was 221% at the end of the year, which is above its 175 to 200% target range. An interim dividend of 7.71 cents per share was announced, which is up 13%, and the group also intends to return another $500 million through buybacks in 2026 and a further $600 million in 2027. And the shares were broadly flat in early trading. In terms of valuation, Prudential has a market cap of $26.2 billion and trades at 11.6 times forward earnings, compared with a 10-year average of 9.9, and it has a prospective dividend yield of 2.2%. I thought this set of results was actually really pretty good. It's had a difficult time in the last few years. I'd consider it part of what was my kind of legacy portfolio and stocks that I wasn't really involved in choosing. I think the company had been pretty bloated around 5 years ago, and they pivoted essentially towards the growth market in terms of Asia, China, India in particular, and selling whether it's life insurance, health insurance products over there. And essentially they had more mature parts of the business. So they had the insurance division over in the States, which was Jackson, and they also had M&G, which we're also covering today, in the UK. And they spun those off separately around 5 or 6 years ago, and then focused on the growth in the Asian market, which I think probably differentiated it from the other insurers listed on the FTSE 100. I think with growth in China slowing, essentially you saw that in the Prudential numbers. I'd held it for a long time. It hadn't really done a huge amount. And I would admit, I've quoted some of the metrics and the ratios today. It is quite a business that's quite difficult to understand if you're not in the industry. And that was part of the reason that I sold it. And also that it hadn't really been doing all that much. I think in the last year, we're actually starting to see signs that fairly decent growth is returning. And operationally, it does look like it's a pretty well-run business. I think I sold, back in March time, which I'm no good at timing the market. I think it probably is a fool's game. And a case in point, when I sold it, I think it's been one of the best performers in the FTSE 100 since. A little bit of seller's remorse there. I think overall, it probably is a very well-run business, and it does seem to beginning to deliver on its strategy. I can't proclaim that I understand it well, and I think for me it does go in the too hard pile. Sam, what are your thoughts on these results from Prudential?
Very similarly. I think these are a good set of results. I think the pivot that they've made is, I guess it wasn't really a pivot, but I guess that decision to focus on the Asian market probably was the right one. I think that's probably where the best opportunity was. Yeah, but again, I just don't like those types of businesses. I don't like the funny ratios. I'm not fully comfortable with them. I think for someone who is comfortable with those kind of businesses, it's probably worth a look, but I'm quite happy sitting on the sidelines with this one.
Fine. How are JD Sports doing?
So they are, well, they're not doing very well, actually, I didn't think, although the market disagreed with me. So they have come out with their Q2 results. I'm sure they don't need an introduction. It's JD. I'm sure everyone in the UK knows them. And people abroad are increasingly beginning to know them as they're rebranding a lot of stores now to the JD brand. So they have reported a 3% decline in like-for-like sales over the second quarter, which was in line with expectations. All regions posted declines in the period except for Asia Pacific, which was up 0.3%. Trends in the US are improving, while Europe and the UK were impacted by tough comparisons due to the 2024 Euros. Disciplined discounting and inventory management meant gross margins were only down 0.4 percentage points. Full-year underlying pre-tax profits are expected to be in line with market forecasts of around $885 million, which will be weighted towards the second half of the year. The group does not expect the direct impact of US tariffs to be material. I'm surprised by this one because I'd have thought a lot of the products would have been subject to tariffs, but they'll know more than me. But I was surprised to see that. A new £100 million share buyback programme has been announced. And for context, that is on a market cap of 4.46 billion. So it's about 2.4%. So I suppose that's on top of any dividend as well. And the shares rose 4.5% following the announcement. Like I say, I don't think these results were particularly great, but I guess the market was factoring in worse results. And we'll get to that a bit more when we get to the valuation. But it's worth pointing out that the US, well, it's been a problem recently for a number of reasons. So the first one's the macro environment. The second one is that there's been delays with certain product launches. And the third one is because it's been quite a tough market, a lot of the competitors have been discounting quite heavily. JD has made the decision not to do that, which I think is probably the right one, assuming the US operations were in line with the UK, which is perceived to be quite a good quality brand. You wouldn't put it in the same category as a Sports Direct, whereas the competitors have used more promotional activity to try and clear the stock. The Hibbett acquisition, which we have covered in the past, so that's one of the US retailers that they bought, that means that the US is now JD Sports' largest region by sales, making up 36% of the total. In terms of the valuation, business trades at a forward PE of 7.5, and that compares to a 10-year average of 15.7. Prospective yield is 1.2%, but as mentioned, you do need to factor in the buyback, so you're probably looking at more like a 3.5% yield, and that 10-year average is 0.5%. I think part of the reason this is, these results I don't think are fantastic. I think that forward PE, I think the reason the stock has responded so well to these results is this is one of the stocks we covered during the Orange Swan, and at that point it was at a PE of 5. And I think it had just gotten so cheap that unless it's going bust, a PE of 5 probably is just too cheap. It was priced like it was a tobacco stock. So I think it's more that people have realised it's going to be around for a while. And I think, 5 times earnings, it was just way too cheap. It was a business that I looked at that time. However, at that time I bought Nike and I felt like they were too similar. I didn't want another retailer after my experience with Boohoo. And I'm quite comfortable with the decision to buy Nike instead rather than get it vicariously through JD Sports. So, yeah, I think that's probably the reason why. I still wouldn't be hugely comfortable with it in the long term, but at a forward P of 7.5, I can see why someone would make an argument because I think it is still a quality brand. Although I would have long-term concerns about the direct-to-consumer from Nike and Adidas. I appreciate that's not done as well in the last few years, but that does seem like a trend that's only going to go in one direction over time. But again, I think that decline could take a very long time. And I think at a forward P of 7.5, I think you could probably still get a pretty decent return. That being said, it's not a stock that really interests me. What about you, John?
Yeah, very similar. I think direct-to-consumer in the long term would be a concern. I know you can make a value argument with JD and you can make something of the argument for JD as a brand in itself, but I think there are better businesses out there with less risk, so it wouldn't be one that I'd be dipping into.
Right, well in that case, now that we've done Prudential, should we see how... Is M&G, that was the one that was...
It is, yeah. So it's essentially the savings and investment company that was spun out of Prudential in 2019. It's split broadly between two arms: the asset management with around 350 billion pounds worth of assets under management, and the life insurance division with both annuities and more specialist products. They also had their half-year results out with revenue broadly flat, with a broadly flat first half in terms of underlying operating profit of £378 million against £398 million that was expected. Assets under management rose 2.5% to £354.6 billion, and net flows from open business turned positive with an inflow of £2.1 billion against the £3.1 billion outflow expected. The shareholder Solvency II coverage ratio, a measure of balance sheet strength, rose from 223% to 230% since the start of the year. An interim dividend of 6.7 pence was announced, which is up 1.5%. And looking ahead, underlying operating profit is expected to grow at an average annual rate of 5% or more over the 3 years to the end of 2027. And the shares were down around 2.5% in early trading. In terms of valuation, M&G trades at 9.2 times forward earnings, which is broadly in line with its listing in 2019, and it has a prospective dividend yield of 8.2%. and the dividend yield has averaged 9.8% since listing. I thought these results were actually all right. I know it missed initially on the operating profit that was expected, £398 million, and outflows against 3.1 billion expected actually came with an inflow of 2.1 billion. So I think overall it was decent. I think, again, as I mentioned with Prudential, it is a difficult industry to understand. I think you could definitely make an argument in terms of the income play from it, and it's arguably been undervalued over the last few years. I think I held it for probably about a year and then I sold it, but it has kept the dividends consistent, and whilst the results aren't shooting the lights out, it has been growing the business gradually. I think it's benefited from the rising of the interest rates and the popularity of annuities growing as well. But again, it's not one for me, although I think underneath it looks from a layperson like it's probably quite a good operator. Sam, what are your thoughts on M&G?
I don't think it's terrible. I think the results are okay. I think probably the main thing in there is if they can hit that 5% a year to 2027, that would be very good, I think, for a business of their size. However, I just think it looks a bit stodgier. The growth's slower. If I had to pick between M&G and Prudential, I would rather own Prudential. I don't really want either for the reasons I explained with Prudential, but I think that's also reflected in the price, in that M&G is at a forward P of 9.2, whereas you can get Prudential for 11.6. I think I'd probably rather pay up for Prudential because it is probably the more exciting business.
Yeah, and I guess it's dividend versus growth, isn't it?
Yeah, I guess, I don't know, if I was looking at it, I think with Prudential I'd maybe take a few, or you get that growth and then you'll get the dividend later on.
Yeah,
but as well, I would quite like the diversification element, that it's more of an emerging market play.
No, fair enough. Okay, on to a new REIT.
Yes, regional. So this was actually, it was mentioned by someone at my work. They were very, very clear to point out that that was not a tip or a recommendation. And I think with good reason when we drill into it. But it was mentioned in the context that it is really a discount, even compared to what you'd normally expect from a REIT. So for a bit of background, because we've never covered it before, so this is from the fact sheet on their website. It is a real estate investment trust, as you would imagine, and the portfolio comprises mainly of offices, with 90.4% of the portfolio made up of offices as of June, located in the regional centres of the UK outside of the M25 motorway. So basically looking for stuff outside of London. They have 123 properties, or this is as of June, 740 tenants. The value of the portfolio was just over 600 million. The rent roll was 56.7 million, and they had a 43% loan to value. The average cost of debt is only 3.4%, and that's fully hedged. The average occupancy, I think, is 2.8 years, and that's at a 78.6% occupancy rate. And the valuation yields are at 5.8%. 84% of the properties are in England and Wales, and the largest property is 3% of the portfolio, and the largest tenant is 1.7 million of rent. They've highlighted that office occupancy rates are reaching their highest levels since the pandemic and continue to increase, and rent collection averaged 99% for 2020 to date. They have come out with their half-year results, and it's a half-year results, but it's 70 pages, actually, so it's a bit chunkier than me. It seems more like an annual report, the way it reads, actually. So it's going to be a bit slightly scatty, because I'm going to go through like the chairman's statements and stuff before we get to the actual figures. But it's worth mentioning that in 2024, they did a £110 million equity capital raise. This is not a good thing. I will cover that in more detail later, but just be aware that's happened. You've said since the May trading update, the group has secured 7 new lettings and 8 lease renewals, delivering over 1.6 million in annual rental income, representing a 6.3% uplift above estimated rental values. They said for the period under review, the company declared fully covered total dividends of 5p per share. Fully covered, again, I'm going to cover it in more detail later, but I'm just kind of going off with what they're telling us at face value initially. But 5p per share, this is the 6 monthly dividend. This isn't even the full year total. But that 5p per share that is allegedly fully covered, that's on a share price of 117p. and you usually get another 2.5p later on in the year. So again, cover it later on. It's currently yielding about 12%, which they are claiming is fully covered. So in terms of the lease expiry profile, it's okay, but 12% of the leases expire in a year, another 10.5% the year after that, another 41% expire within 2 to 5 years, and then 37% expire in 5+ years. Now, I think one thing that's worth noting is obviously in terms of those leases, I suppose it's not, the debt to value is 40%, 43%, which isn't a hugely concerning figure, but the average cost of that debt is 3.4%. Unless something radical changes in the next couple of years when this starts to renew, when these start to come to expiry, I don't think the majority of these will be getting renewed at 3.4%. Yeah, so that's something to factor in. Although I think a lot of REITs will probably have the same issue. In fairness, that's not just going to be a problem for regional. So in terms of the actual figures for the income statement, the rental and property income was down from 44 to 40 million, so down about 10%. Property costs were basically flat. Admin and other expenses were up from 4.7 to 5.2 million, so up about 10%. There was loss on disposal of investment properties. Looks like there was change in fair value of investment, so some of the properties have been revalued down, so they've been impaired. Finance expenses, they were down from 8.2 to 6.4 million. And then, although they were down, they had a net movement in fair value of derivative financial instruments of 3.5 million, which basically means that the overall finance cost was pretty similar. So rents are going down, costs are going up. Total assets, that's gone down. That'll be due to the impairments and the revaluations. They've also sold a few properties as well. But bank borrowings, they're actually down. That's mainly because of the equity raise. So the long-term bank borrowings are down from 348 to 306 million. That's because a good chunk of that equity raise was used to pay down some of the debt. And the share capital's gone up. So the share capital was 513 million shares. It's now 618 million. That's because of that 100 million equity raise that we mentioned. In terms of the valuation, the business has a dividend yield of 12.2% and trades at a discount to the net asset value of 42.4%. It's normal for REITs to trade at a discount to the net asset value. You would normally take it with a bit of pinch of salt. I'd take it with a huge pinch of salt in this case, especially given that a lot of it's office buildings. Yeah, if you're looking at that, this isn't the kind of REIT that's probably ever going to trade at the net asset value. There's always going to be like a sort of 20-25% discount for a normal REIT. And I don't think this is going to be like a Tritax or a supermarket income REIT where it might actually get close to the net asset value at some points. In terms of the share performance, it's done terrible. You could have bought it in 2015 at £10 a share. It's now £1.17. In the last 5 years, it's down 83%. In the last 3 years, it's down 83%. In the last year, it's down 13%. In terms of some of the stuff that they've talked about in that fact sheet and in the results, I just want to break it down into a bit more detail. So if we look over it in the last 5 years, the company's not done very well. The share price has done terribly. The reasons behind that, partly due to the falling office valuations, as you would expect post-COVID, high vacancies, which they're not, they've still got about 20% unoccupied. 20% of the properties are unoccupied, something like that. I think it was 22% or something. Despite what they say, the dividend yield is not supported by earnings. So the dividend exceeded the earnings or what you'd consider normal earnings. However, that includes one-off asset sales. So unless they're going to sell the family silverware every single time they want to declare a dividend, it's not really covered. I think it's going to have to come down at some point. And I think that's partly why the yield's so high. I think this is getting cut. I don't see how they can keep paying this out unless they're going to keep selling properties, but I doubt it. We kind of hinted at it, but obviously post-COVID, you've got more hybrid remote working, so there's less demand for offices. It has recovered somewhat. I think maybe in their favour, it just seemed to be the last sort of year or two, there seems to be a bit more of a push by a lot of businesses to get people back into the office, and people have maybe noted that certain people may be less likely to work as hard if there's no one else monitoring them. In terms of the vacancy rate, as we mentioned, that's around 22%. The tenants they have are very good payers, 99% rent collection, as we mentioned, since 2020. And the shareholders in the equity raise were diluted, I think, about 20%. So I think it's interesting. It's not often you see a 12% dividend yield, but I think the issue is I wouldn't really consider it. I think you can see it with the properties being impaired. It's trading at a discount to the net asset value for a reason. I think it's really difficult to value some of these office buildings. And, if no one wants to rent them, that suggests they're maybe not as valuable as they might be on the books for. I think the dividend's going to get cut. it's probably a sector longer term I'm not comfortable with. Maybe if it was part of a bigger portfolio and it wasn't just fully exposed to office buildings. But, if I was going to get a REIT, I'd rather have a lower yield and have something higher quality, like Supermarket Income REIT, like Tritax, like Primary Health Properties. So yeah, it's cheap, but I think with good reason. So I just wouldn't touch it with a barge pole. What about you, John?
They're short leases. The debt is going to get more expensive. And in terms of what they're actually leasing, yes, I know there is a REIT bound to a degree in terms of office space, but I think there is only so much that can be charged for that. And, switching to hybrid working is much easier for businesses to do now since the pandemic. And yeah, I don't think that dividend is sustainable, and I'd be worried about the company. I think there are a lot better REITs that are available, albeit with lower but sustainable dividends.
All right, shall we move on to a slightly higher quality business then?
Oh, goodness, yeah. So I think it's the largest company in the world by market cap currently. I'll have to double check that, but it's Nvidia. We've covered it plenty of times on the show. It's had its Q2 results out with Nvidia and OpenAI announcing a partnership to deploy 10 gigawatts of Nvidia-backed data centers. As part of the deal, Nvidia will invest up to $100 billion in OpenAI, progressively as each gigawatt is deployed. The first gigawatt is expected to deploy in the second half of 2026, built on Nvidia's upcoming Vera Rubin platform. In other news, Nvidia announced a partnership with Intel to jointly develop custom data center and PC products. As part of the deal, Nvidia plans to make a $5 billion investment in Intel shares. Nvidia has also become a key partner for the UK government in its AI ambitions, and Nvidia is set to invest £2 billion into UK AI startups and deploy its Blackwell platform as part of the UK's largest AI infrastructure rollout. And the shares were up around 4% on the announcement. In terms of valuation, Nvidia has a market cap of $4.29 trillion and trades at 32 times forward earnings compared with a 10-year average of 27. I think this is very exciting for Nvidia in terms of the tie-up and the deal with OpenAI. Massive investments being talked about, and it's particularly interesting from a UK perspective, although I suppose on the scale of how big Nvidia is, £2 billion, whilst a lot here is, I suppose some would argue, slightly more modest by the scale of Nvidia. But overall, $100 billion worth of investment, I think it's very exciting in further revenue streams for Nvidia. As I think we've all become to appreciate, it's an incredibly high quality business. It's by far and away the best in class. It is the definitive play on the AI investment, the AI theme. And I think it's another thing that's sometimes not touched upon quite so much is how capital light it is, because it outsources all the manufacturing. And I guess one thing that always dominates, despite how fantastic the business is quite how large it is, over 4 trillion in market cap. And yet it still has a massive valuation in terms of 32 times forward earnings. I certainly wouldn't bet against Nvidia. I'm quite happy having it as part of my world tracker. Would I buy shares individually? I don't know whether I'd be brave enough, although I think what a business. And it does continue to prove the doubters wrong. Sam, what are your thoughts on the latest news from Nvidia?
Pretty similar. I wouldn't bet against it. I think in terms of justifying that valuation, they are doing all the right things. Every time we cover them, it's just a fantastic set of results. I just wouldn't be comfortable paying 32 times forward earnings for a company that big, even if it's one of the best companies in the world. So yeah, it's really, really impressive business, really interesting to follow them, doing everything right. But I just think at some point, the laws, I've been wrong for years, but the law of large numbers has to kick in at some point. But maybe in 5 years' time, I'll still be saying it.
Yeah, no, absolutely. Okay, then, of the companies this week, what would your top pick be and what would come last?
So I think top pick would be Tritax. I think bottom pick would be Regional by a distance. I think probably it's worth mentioning Nvidia is obviously the best business, but it's just valuation. What about you?
Yeah, I mean, it sounds a bit boring. Nvidia would be far and away the first choice, but on valuation grounds, I'd probably play it safe and go for Tritax, which I think in its own right is a brilliant company. Last, yeah, I think it's got to be regional, and then you've got a hard pile of Prudential and M&G, but it's quite an easy one for the first pick this week.
Right, I think that's everything in that case.
Thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.